Clayton Collins. Welcome to Acquiring Minds.
Will, thank you for having me.
This is going to be fun for me, Clayton. You bought a media business and a media business in real estate, no less. There was a time when I had a media business in real estate, much smaller than yours. Let's get into it, Clayton. Some background on you, please, and take us up to what led you to want to buy a business in the first place.
Awesome. Well, appreciate it, Will. I'll do the abridged version and we can go deeper wherever you'd like. But I started my career in banking in a management program at Citigroup, had some awesome exposure leading people in retail and small business banking at a super early stage of my career. After a few years in retail and commercial banking, went back to business school, pursued the investment banking route at RBC Capital Markets. And at RBC, I was a generalist banker, but I fell in with a group that did a lot of tech, media, and telecom deals. And I had the chance to lead or take a leading role in a few small sell sides at RBC of digital media companies. And getting a chance as a first or second year associate to work closely with the general managers and CEOs of these small media businesses that we were selling really got my entrepreneurial interest kind of spinning. And I thought more and more about where I wanted to take my career. And it brought me back to something I learned about in business school. And that's entrepreneurial acquisition and search funds. So after a few years as a banker, Will, I jumped, left RBC and started a search fund to go hunt for a business to acquire and operate. And that's kind of that's the background before we get to the beginning of the HousingWire story.
Awesome. That was great, Clayton. So to be clear, you had an MBA and actually went into banking. And then it was a few years later, because often searchers will come right out of school, having decided to search. Not so for you.
I'd gone to business school relatively young. I went back to business school at Duke after 3 years of post-undergrad experience. And I felt like coming out of my MBA, I was still a little bit green and had a little bit more experience that I wanted to gain before pursuing the search route. So I learned about search funds in business school in 2011 or so, but felt like I wanted some more transactional experience and just exposure to the deal world before jumping down this path.
And as you reflect back, do you feel like having been in banking that it ended up being really relevant experience?
That's a question I've thought about a lot. And it's certainly relevant experience and has shaped the type of CEO that I am. I'm pretty acquisition focused in our strategy, but we certainly know how to pull the organic lever. But I do think that without the M&A experience, I'd probably be a slightly different type of operator. But when I think about the experience that was most important to me, it was really those first couple of years out of undergrad in a generalist management associate, management training program that has prepared me best for the responsibilities as a CEO. So I thought that I'd be looking back at my investment banking experience with all these tools, tactics, modeling skills, negotiation skills that'd be so important as a CEO. But it was really that experience in my first few years out of school at Citi, leading teams that most prepared me for what I was going to face in this entrepreneurial path.
Because the entrepreneurial path is more about management than it is about deal making or the financial piece.
Yeah. I mean, when we acquired HousingWire, the business had 14 people. Before that, I had led a branch at Citi in Midtown Manhattan that had close to 30 employees. So I had experience leading a retail branch with more employees in the business that I had acquired. Now, that was a short-lived experience at Citi. It was in the middle of the financial crisis, incredibly tumultuous time, which also shaped my management skills in a way. But that exposure of leading teams, opening the office every morning, getting people, on task and ready for the day, particularly in 2009, which was just wild, definitely prepped me for these early managerial challenges that I'd face as a search CEO.
Mm-hmm. And when you've said that your banking experience probably oriented you to being acquisition focused. So that's not the only story here, but it is a big part of the HousingWire story, which we'll get to. When you have done those acquisitions, jumping ahead a little bit, when you have done those acquisitions, are you leading them? Are you the finance guy because of your banking experience?
Yeah, I mean, over the years, we've kind of formed more of a deal team, which is, two or three people, depending on the deals we've worked on. I am definitely extremely hands-on in our deal processes. But now that we've done 5, I have a finance leader, Andrew, who is incredibly important at moving deals forward. And I lean on him heavily for financial analysis and modeling and working with our accountants and lawyers and in the diligence process. So as we've gotten slightly more mature in our deal experience, it's not just me running solo, but the first few, it certainly was.
Yeah. Well, I'm picking at this, Clayton, only because there are a lot of listeners who don't have finance backgrounds.
Yeah.
And for those folks, often hearing the preponderance of former bankers, people with MBAs, former private equity types can be like, oh, do I have to have that experience to go do this? So that's why I always press and try to understand from each searcher's experience who does have that experience, how relevant was it ultimately?
I think as an entrepreneur or an operator, a CEO, you are going to have to, and you're going to want to, and the most important part of the job is hiring people with strengths other than yours to be around you. And hiring finance and deal talent is a very easy thing and smart thing to do. So if you're an operator going into an acquisitive strategy without deal experience, no, you shouldn't venture in blindly, but you should hire the right people around you, whether that's bankers and advisors, an experienced chief of staff, tapping a board member or investor to kind of join you in the saddle as you go through the first tuck-in or add-on acquisition. Or if the business is of the scale, hiring a corporate development analyst or associate or someone to work on your mini deal team. So I think as an operator, you have to, and it's the most important thing of hiring people smarter than you to supplement your skill set. If you're a fabulous deal person, you're probably going to need some great general managers and marketers and sales leaders around you. If you're a fabulous sales leader, there's going to be other parts of your skill set that aren't as developed. So being honest with myself as a CEO about where my strengths lie and where I need to, in the early stages of the business, put smart people around me, I think was an incredibly, important activity and incredibly important step in this journey.
Great. Well, we're gonna hear about what gaps that you saw in yourself that you then filled and how you did that. But returning back to where we were in the story at the very beginning of it, Clayton. So it was actually working on deals that related to media industry, telecom media businesses that was finally got you excited enough to go out and search. And so that is to say that you had a media related thesis. Tell us, take us into your search now.
My thesis was more so built around information services, technology, data with a little media bend around the broader financial services and real estate market. But like most searchers, I looked at deals in a lot of areas. But if I had like a generalized thesis, it's that I had a strong background, interest, and experience set around the real estate, banking, and financial services world. And I was initially looking for transactions that helped me leverage that small experience that I had, and like wanting to venture into conversations with sellers and founders where I could at least talk and understand their business and have some understanding of the challenges they were facing. So I was really looking at deals and trying to focus my thesis on areas where I'd have a slight advantage over someone who didn't have the work experience I had going into the search.
Well, you found exactly such a business, but it's kind of remarkable to me because when I think about what your criteria were, the universe of media or data businesses in real estate, and I guess you said finance too, but kind of secondarily, has to be just tiny. or at that time, and probably still, right? This isn't like a fragmented industry with 10,000 mom and pop shops you could buy around the country.
Oh, absolutely. Yeah, no, I can't say I had a thesis that said I'm looking at mortgage and real estate brokerage industry B2B publications. That would have been a week of activity, like talking to everybody.
Right.
And I quickly would have learned there's only one or two that met my size criteria. So this is one of the many spaces that I spent time in during my search. And the reality on locating and finding HousingWire is it wasn't direct outreach, but I was very familiar with the brand. So there was a point in my search where I was looking at data and like information-driven software businesses around the mortgage industry. And HousingWire still to this day publishes a list of the top 100 mortgage technology companies. So I was using a HousingWire resource for deal identification and like calling on people that I had read about in HousingWire. So I think trade publications are an incredibly smart deal sourcing tool for searchers or other entrepreneurial acquirers. And so HousingWire was on my radar for a few reasons, but one that I was using it for deal sourcing.
How funny.
Yeah. So I had familiarity with the business, and I was at a cocktail hour in New York for Duke's entrepreneurship program, probably, I don't know, in the first year of my search. And I met a Duke alumni who wasn't familiar with search, but like later chose to take the search fund route. And early in his search process, he met an investment banker who had shared a deal with him. And his feedback was like, hey, this isn't a fit for me, but it might be a fit for somebody I know. And I got a call from this gentleman and Benjamin, and Benjamin's like, hey, this might be interesting. You might want to take a look at it. And I saw the teaser like without the company name on it. I was like, this sounds shockingly familiar. I know who this is. And I said, absolutely, make the introduction. And so all the proprietary outreach, like knowledge of the business before actually meeting the founders, the ultimate introduction came because I was vocal about what I was looking for, and a friend made the introduction for me.
Great, Clayton. And before we get into more about HousingWire and learning what it was and the deal itself, your search format was a traditional search?
Absolutely. So like I mentioned, I went to Duke for business school. At the time, Duke did not have any type of search fund or ETA club or curriculum. I learned about the search model at a class I actually took at Duke Law, where there was one case study on structuring private equity transactions. And the case happened to be about a search fund deal. And that was my like eye opener to the idea of entrepreneurial acquisition. Because I was coming from a program and a school and really didn't have a network of anybody in the search fund ecosystem, I made the decision that I was going to read the Stanford primer and go like straight down the fairway, like exactly the Stanford primer. This has been successful for other entrepreneurs. I'm following this path as I raise search capital and pursue my search. So I went as like down the fairway as I possibly could. My investor group is entirely search fund investors, folks with a lot of experience in the model, and have proven extremely valuable in the search process, the acquisition process, and now as board members and advisors as we're operating.
You know, Clayton, first of all, what year was all this happening?
I learned about search in 2011. I officially launched my search fund in 2014.
Okay, 2014. And so as you said, you were at Duke's business school. You didn't even learn about search from a business school class, but from a law school class, which is funny. There wasn't an ETA program or club or what have you at Duke. There is at Fuqua. There, of course, there is now. You were basically kind of from a non-search school at the time.
Yep.
What we hear around traditional search is that like the traditional search investors basically recruit searchers from a handful of schools that they have these relationships with. They're all the top MBA programs in the country. If you are not at that phase of life, or you are not at one of those schools, it is hard to get the attention of the traditional search investors, traditional search mafia. But you did it because they weren't at Duke, is my understanding. Is there something to be learned from how you did it for other folks who are not coming out of the top 10 or 15 business programs right now?
Well, I'll be like really cognizant that the ecosystem has changed a lot in the last 12 to 15 years. So like when I was launching, I put together a list, went through every single search fund website out there and put together a list of 40 investors who had backed search funds. Like that was I scoured the earth, and that was like the scale of the ecosystem that I could uncover in 2013 and 2014. That is extremely different today. And at that time, like search investors were getting nearly all of the searchers they needed from a small selection of schools and getting really high caliber searchers. And like that was kind of the ecosystem. But as search has gotten more popular and prominent and more exposure to different schools, and every search fund that launches, it's usually one or two, friends, family, colleague investors that come into the deal. And that's like usually the introduction of a person who realizes, oh, I really like this asset class. And like, this is like, can be great returns. And it's really interesting and it's really fulfilling. And the community of investors has expanded exponentially. Individuals, family offices, as well as funds that have been raised to invest in search. And as the investor population has grown, it's also opened the door for more searchers from different backgrounds, not from the couple schools who have search curriculums, more experienced professionals that, come in at different stages of their professional life, or people who come in before business school. Like the door has really opened up with some positives and negatives. But I will fully admit that my 2014 fundraising experience probably does not resemble the fundraising experience that somebody would have launching a search in 2025 or 2026.
Sure. Good point. Yeah, great point. But what you did was a classic build a list and email them all personally, set up calls and raise the money.
Email personally, it was incredibly important at the time, or at least I felt it was, to get on a plane. So I ran my fundraising process like an investment banking roadshow. I developed a list. I had some pre-calls, and with the little money I had, I went on the road for 3 weeks and just jumping between New York and Florida and Bay Area and Los Angeles and Sacramento and like a little bit in Dallas, jumping around to every investor I could meet, getting in-person meetings, and in each of those meetings asking, is there anybody else that I should know? Is there anybody in your network? Is there anybody you've invested with or you sat on a board with that I should meet? And that question opens a lot of doors, and those warm introductions go a lot further than cold email introduction.
Yeah. It's funny. I haven't, as we talk about it, Clayton, I'm not sure I have asked many traditional searchers like what their fundraising process looks like. I usually just kind of gloss over that. It's like, I raise my search fund and then we hear about the search. So I don't know how common or not getting on a plane and going out and meeting these investors personally would be today, but it's probably, if it's not common, it's probably even more effective today than it was back then, because because there's more search, as you said, it's just a more crowded marketplace.
I think anybody getting on a plane today becomes a differentiated outlier. There's I think all of our inboxes are full of prospective searchers who want to do a Zoom call at the most before asking for a capital commitment. As I'm not an active investor, but I've done a few search deals. The person who gets on a plane that I get to meet in person, that's interesting. And the searchers that I keep in touch with today, the ones that are putting more deals under LOI and have a higher probability of close in their search process, are the ones who get on a plane and go to conferences and meet founders face to face and don't rely on email and Zoom calls as their primary communication tool with prospective sellers. Yeah. So I think there's maybe a little bit of a what's old is new again, Will. That like our digital life is so cluttered and busy. The person who can differentiate with a handshake is going to improve their probability of success in a totally different way than it did for me 12 years ago. But similar outcome, hopefully.
Yeah. Great points, Clayton. Okay, back to HousingWire. Tell us about the business as a business. You've already told us that, kind of what to tell us about what it does, and then we'll get into the numbers and such, what it looked like behind the curtain.
Yeah, so HousingWire is a business media and information services company serving mortgage and real estate professionals. So we believe in a media and data flywheels. We have a team of reporters and editors that cover everything that happens in the real estate, housing, and mortgage market, whether we're talking about mortgage rates, housing inventory, M&A, executive moves, technology innovation. We have an awesome team of content creators and reporters who have tight relationships with the industry. And we publish all of this through HousingWire.com, newsletters, podcasts, and event stages. So there's the media element. And then over the years, we've built out data, subscription, and software elements of the business organically and through M&A. So my vision for HousingWire is to be the Bloomberg of housing. I believe that housing professionals should turn to us to access data on what's happening in the housing market, performance information about who's growing market share, who's losing market share, what originators are having the most success, what real estate brokerages and teams are having the most success, and then the media element of the business can help our audience learn from that data and understand how it impacts or can be applied to their business. So, Will, at a high level, I'm trying to build a Bloomberg of housing. HousingWire is a media and information services business serving housing professionals.
Great. That was awesome, Clayton. And we're going to unpack that a lot in a little bit. But what did it look like when you were first exposed to it? Because that grand vision that you have today was not what it was back in 2015, 16.
Yeah. So the business we bought in 2016 was a digital first B2B trade publication for the housing industry. So there's a lot of similarities to what we were then to what we are now strategically. So HousingWire was initially founded in 2008 during the financial crisis. And one of the founding beliefs of the business that we still hold on to strongly is that it's incredibly important for mortgage and real estate professionals to think about the housing sector as a whole and not just think about their little niche of it. And we look at a lot of the things that went wrong and the things that made the housing crisis and the GFC worse than maybe it potentially needed to be was information asymmetry. Mortgage originators didn't have any idea what was happening in the real estate sales or home building market. They were consuming different media and data sources. Loan servicers weren't talking to and paying attention to what was happening in the loan origination front. Capital markets or mortgage-backed security investors did not have a direct line into what was happening in real estate sales and in new home construction. They all had separate newsletters and digital and print publications that they followed, but they were all niche. And what HousingWire sought to do and what we continue to do is bring together all that information in one place. So whether you're a loan servicer or a real estate agent, you can think about the housing market and the housing sector in totality and learn from what your peers and colleagues are doing in their business that helps make you better understand what's happening in the market and hopefully offer better advice to your clients and employees and make better strategic decisions. So that founding vision sticks to today. Like we still believe that while a real estate agent might not be interested in everything happening in loan servicing, they should have the opportunity to understand what's happening in loan servicing and the massive shift we're seeing in the market right now, because ultimately it does impact their consumer.
Can you give us some numbers around what it looked like at 8 years of age in 2016, HousingWire? By the way, so it launched in 2008 to kind of redress this information, what the founders saw as an information siloing. They were like,
exactly. And there was in that like 05 to 09 period, it was a little bit of a emergence of entrepreneurial bloggers who were publishing content. Like the early stages of digital media when launching a site or a blog was pretty accessible. And so the founder of HousingWire was part of that emergence. I mean, he was publishing while he had a day job, was publishing at night about what he saw happening in the housing market. And with some initial digital traction, that formed the baseline for what later became HousingWire. So when we bought the business in 2016, HousingWire was a digital first publication, but still had a print magazine, which was relatively small, but we were still in print. Most of the revenue was coming from digital advertising and newsletter advertising, and the business was just over $4 million in revenue. So relatively small digital media company, but the growth rate was averaging around 20%. The audience growth was really interesting. There was a moat forming around the business in terms of audience loyalty and the growth rate of newsletter subscribers. And talking to mortgage professionals and clients in the technology and services areas around the housing space, HousingWire had a great brand and reputation and was well regarded as an innovator in the space. And when you look at the world of B2B media, you're often faced with these sleepy print first publications that are way more comfortable on a monthly publishing cycle than they are on a daily publishing cycle, and sort of seen as a press release outlet more so than a news organization that brings unique insights to the audience. And HousingWire was the latter and is the latter. Like, we are focused on really fast daily or hourly publishing cycles. There's days where our newsroom pushes out 22 to 25 articles, which is a mix of, quick hit housing market updates to more investigative, interview first work. And that I saw that foundation when we bought the business in 2016.
Mm-hmm. $4 million in revenue. I imagine margins in a media business are pretty good.
Yeah. But I think, in hindsight, they were too good. So I think there's a level you can run media businesses at where you kick off great EBITDA, but still have the capital and margin to invest in growth. And then there's a level you can run at if all you're worried about is cash flow and boosting EBITDA margin. And I definitely evolved the business to an EBITDA percentage that lets me invest in growth while simultaneously growing cash flow each year. So when I think back on the business we bought, buying at nearly a 40% EBITDA margin was was kind of a level that, we could have stayed there, but we would have stayed at that same size forever because all resources were coming straight out the door. But if you really want to invest in a modern technology infrastructure, marketing, growing the newsroom, building data products, launching an events business, that margin profile wasn't sustainable at the growth rate I wanted to run at.
Sure. Well, even at 40% of $4 million in revenue, that is going to be on the small side, quite small for a traditional search fund. But as you just put it, those 40% margins were kind of not sustainable if you wanted to have any sort of growth. So your kind of forward-looking margin was going to be less than that. How did you get comfortable with the size of the business being a little bit smaller than you or your investors envisioned you buy?
Yeah, so we were just shy of that 2 million in EBITDA level. It wasn't shockingly lower than a lot of the places search deals were getting done at in 2016. But no, you're right. That was a hurdle. The vision for what we wanted to do with the business and the platform that I saw in HousingWire is what helped me and investors get comfortable with the starting point. And we saw a business where there was products that hadn't been launched yet. Subscription, events. We saw a business to be a platform for M&A, and having that strategic vision for the growth path were really important elements of what gave me conviction in this platform.
Yeah, and I want to have you double click on that in a second, but just before we get there, Clayton. So, how many employees was it in 2016? Did you say
14 people in Las Colinas? So we're out in Irving, right outside of Dallas, by the airport. That first office it felt great at the time, but in hindsight, I'm very happy to be out of there.
Okay, and you said it was newsletter sponsorship and sponsorship on the website.
Yep,
was the primary revenue, and they were selling $4 million of ads in those across newsletter and website.
Print was about 10 to 15% of the business initially, and we kind of had the budding content marketing arm, but that wasn't like nearly what it is now. So like we were doing some content marketing, webinars, white paper type work. So the revenue was diversified across different marketing products, but it was all advertising and marketing services.
Mm-hmm. And how do you think about the quality of revenue for marketing? Not what it is today, but what it was back then. Do you think of advertising campaigns? Where is it on the scale of quality of revenue?
In the broader media and information services space, I'd say, digital advertising revenue is kind of like middle of the pack, print incredibly low. Print tends to, part of just the technology evolution, but tends to be like the most cyclical revenue stream. When markets are great, marketers are willing to throw brand dollars at print advertising. When they're not, those dollars disappear really quickly. Yeah. And as we've looked at M&A opportunities over the years, particularly of businesses that have a print element, the volatility in the print revenue line, it doesn't shock me anymore, but to someone who hasn't seen it before, it would shock you on the year-to-year volatility in print. So I'd put print at the bottom, digital in the middle, and would love to talk more about the high quality revenue sources and subscription and events that we've migrated to.
Yeah. When you say digital is middle of the pack, but digital sponsorship is also quite cyclical.
It's not. Okay. So there's different, like digital can take a lot of different flavors, and you look at the broader digital media field, and that you hear the venture-backed media companies who have hired thousands and fired thousands because of digital advertising volatility. Yeah. That is often programmatic. We have always maintained direct relationships with all of our advertisers, which was one of the really compelling diligence points when we bought the business. Is there's clients that we've been working with at that point for 8 years, at this point nearly 20 years, that we've been pretty integral parts of their launch and growth strategy. So while revenue might move between digital products a lot at that time, and still to this day, the spend from certain accounts was relatively consistent. Mm-hmm. So that's why, like, even as we look at M&A, like a pure digital advertising business can have way more consistency than the headlines would imply.
Mm-hmm. Yeah. And just for the audience, I don't know, I don't want to presume knowledge of online advertising models, but when you said programmatic acquisition, being a media guy myself, that's all very familiar concepts. But just in case, so programmatic, the media business is the BuzzFeeds of the world within. That's an old story, but maybe they're more recent ones. But these venture-backed, very large scale media businesses that expand and then contract. The ads that you see are generated by third parties, namely the social networks like Meta or Google. And they're not selling directly. And selling directly means you have a direct relationship with your sponsor, and there's often some sort of kind of bespoke, not always, but often there's a bespoke offering to them. So like with my sponsors on Acquiring Minds, I have direct relationships with them. I'm not having any sort of programmatically injected ads into the podcast. Although even in podcasting land, that model also exists. So for really, really big podcasts, they might be able to make money that way. But for niche podcasts, usually the relationship with the sponsor is very direct between media publisher and sponsor.
Yeah, I think the modern publisher has kind of moved to a place where direct is the most important advertising revenue source. And, that's me calling a client directly, building a relationship with the CMO and doing understanding their growth strategy and doing a direct insertion order or contract. And programmatic, it's Google Ad Manager or one of the social platforms or the thousands of other ad marketplaces that feed ads to digital publications. The difference between the two is in direct, we have the chance to actually hear a company's growth strategy and help them develop a advertising approach that moves their ideal client profile targets through the funnel. So helping them build brand, build product awareness before we move into call to action marketing and actually try to drive leads or conversions on their website. Where programmatic is often, or at least what we see in B2B land, way more direct response, like bottom of the funnel focused, and we're able to help clients move people through the whole funnel.
Yeah, yeah, that's a great point. Also, with programmatic, you don't have relationships with your end customer. All you have is the little snippet of code that you're embedding on your website that then dynamically populates with, Meta's client, not yours. Not a very strategic place to be.
Yeah, it's an important part of the strategy. Like, I mean, I think programmatic and retargeting and social campaigns are like, all smart marketers are using those to some extent, but there is also huge power in the direct relationships with content creators like you will, and publishers like HousingWire.
Great, Clayton. Can you tell us about the terms of the acquisition?
Yeah. So it was a founder transition scenario. There was two founders, 50-50 owners that were both interested in moving out of the business. So the terms were very focused on helping make that a reality. And so we used senior financing, a small seller note, and investor equity to fund the deal. From my vantage point, if you're not planning on having a founder or seller stay in the business as a key executive, rolled equity or large earnouts are a little less relevant. So we went with the structure that supported the management plan and transition that we had in place.
Did you say there's conventional debt there? There was a debt piece?
We did, yeah. We used conventional senior debt. I think it was about 2 turns of senior at time of acquisition.
Now returning to your vision, Clayton, as you put it, I do think this is a story of, capital ETA, where there's sometimes people will say, don't forget that ETA is about entrepreneurship through acquisition, because sometimes there can be an approach that's more about, harvesting revenues from a business and kind of running it, and maybe it's financial engineering where there's going to be value creation or extraction, versus entrepreneurship where you might say there's more vision involved. There's not where are we today, but where can we take this? But again, stories of real kind of entrepreneurial vision, I'd say, are probably less. There are lesser of those in our world. But you seem like a great case study of that. You saw the raw ingredients of something that was, what they had built, the founders had built, is very impressive. A $4 million media business is great. But you saw where this could go, and that was a much larger vision from what it currently was to where it could go. And that was, you had to sell that to yourself, you had to sell that to your investors, and that was really what this whole project was about. Care to respond to that?
No, I mean, I think everything you just said is 100% spot on. And when I think about search, I think about capital ETA. I like how you put that. I think those are synonymous. And I've always had a viewpoint in this space that if you're looking to use ETA or search as a launch point to a private equity career, or you mix up the terms with independent sponsor, you don't understand the space well enough. Like, search is about helping aspiring entrepreneurs find a starting point and get into operations and lead a team. And the acquisitions that we do help these aspiring entrepreneurs like get a leg up, start with a great platform and a strong team they can run and build with. And I think over the years, and I've owned and operated this business for 9 years now, that has only gotten stronger in my view, that this path is about entrepreneurship. It's about leadership. It's about general management. There's times where it's about capital allocation and the finance side, but only the best operators get to a point when they can really start thinking about using their business and its cash flows for further investment and a lot of, strategic finance activity. So I think anybody who doesn't want to actually get in there and lead people and then build product and sell and market, this is a tough path. That's not going to be as fun for you as it has been for me.
Yeah. Well, I'm totally on board with all of that, Clayton. But putting on my investor hat now, I could also see how search investors looking at your deal would say, I'm inspired by your vision. I too can see the vision, but there's just too many unknown unknowns there. Who knows if this category can support an event? Who knows if you spin up an event whatever, any number of things can go wrong when you're starting with 0 events and envisioning launching events. Same with a data business. Who knows if there's a data business to be had there? There's just a lot more ifs when you're buying a vision or when you're investing in a vision versus just doing more of the same. So really, this is just a philosophical back and forth, but I'm curious, did all of your investors choose to invest?
They definitely did not. So like
for that reason?
It's about, I think it was 60% of search investors participated in the deal. Some of them at significantly larger than pro rata, others at less than pro rata. And I still had an equity gap and brought in a few new investors from the search community who have proven to be wildly helpful partners. So like I think that's another like great point, Will. And you think about the ETA path, a big part of it is conviction by the entrepreneur. Is this a business that you want to buy and lead and see yourself being successful in? And if so, that is a reason we build diversified investor groups. Every deal is not going to be the right fit for every investor. And when you look at some of the evolutions of the ETA model, where searchers might be backed by a single private equity firm or a single family office, that's a different consideration. If the deal is not a fit for 100% of the investors, you're one investor, it doesn't get done. Where traditional search was built to bring capital diversity to every deal. So new perspectives, new convictions could influence whether a deal gets done. And that's exactly what I learned as I went through funding this deal in 2016.
That's great. I had never heard that point made about the kind of diversity of capital sources, and the traditional search has that kind of baked into the model.
As the model's gotten more mature and hundreds of deals have gotten done, most industries have been invested in, and investors often form strong positive or strong negative convictions on certain business models in certain areas. And if I'm talking to a recent business school grad who's building an investor group, strategically, I advise them to think about that. Like, are you bringing in people with different backgrounds and business experience and investor interests? So if you do stumble upon a deal that you have high conviction in, everybody in your search group doesn't kind of fall into the same thought pattern or maybe have the strong negative convictions around one space. So capital diversity, I think, is one of the big selling points of traditional search.
I want to spend time on how you have now effectuated this vision, because you have, and it's really impressive and exciting, especially as a media guy. But anything to say about the first year, the early years, the transition, or should we get right into your big strategic moves over the years?
Yeah. So, I mean, I'd say the biggest point I'd make is the first few years were tough, and media businesses, and like probably one of the biggest surprises that I had was the sales intensity. And moving one of the founders was running sales in the business. It was always part of the plan for him to transition on and hire a new sales leader. One of the things we learned is that that sales leader was playing a pretty important role in the pipeline development of all of his account executives. So like the account executives weren't exactly like lifting as much weight as the data showed. And so the first few years were largely spent rebuilding and like re-strategizing our direct sales approach. And the first like senior move I made in 2016, we bought the business, was hiring a new head of sales, Jennifer. She's still with us today, 9 years later. But the number of times that her and I over the years have essentially rebuilt the sales team to match the market, match our opportunity, handle attrition. It's probably like 3 or 4 times. And it's just been such a fabulous experience in building and leading sales orgs. But I certainly have to acknowledge that like building a sales org in those first few years was my number one challenge and got nearly all of our energy.
And was that because the $4 million in revenue that they were currently selling was there just wasn't a lot of reoccurrence of that revenue, and so you needed to improve the quality, and that's what needed to change, or did revenue collapse when you got in there, or something like that?
No,
what was it
didn't collapse.
That made it such a priority?
It didn't collapse. There was just things that we learned. So one of the big ones was single point of contact relationships. So if you have a strong relationship with the CMO of a company, that CMO moves on, you haven't built like downstream relationships with the marketing VPs and marketing managers who might stay after a CMO leaves, that's a challenge. So like building a sales org where we can build multiple touch point relationships was a critical part of that. So that meant going from just having account execs to also having like an account management and client success function, which helped us have multiple touch points from our organization, but also create multiple relationships inside of our client organizations. Mm-hmm. You mentioned this on the front end. We bought a media business in the housing industry. Both media and housing has some cyclical factors. No one really outside of the industry remembers this, but in 2018 and 2019, the mortgage industry ran into a pretty strong margin compression cycle where mortgage lenders were not profitable. And so COVID was like a big savior to this like margin compression era that we've been running in 2018 and 2019. So that was also another element. We're managing a new business with a new sales team in a really constrained environment. And so learning's all over the place, Will.
Mm-hmm. Great. So you emerge from that, or you kind of get your arms around that. And when do you decide to start making some of these strategic moves that you had envisioned from the outset, new product lines, essentially?
Yeah. So inside of our advertising business, we were launching new newsletters, building out sections of the website, focusing on certain audience segments from day one. But we didn't really start making strategic moves until it was about 2.5 years into owning the business. We launched our first event. We had hosted 3 events before COVID and felt like we were really getting our feet underneath us and learning the event industry. In 2020, we had the opportunity to do our first acquisition. So our first M&A deal was 4 years after we owned the business. That was a company called RealTrends. RealTrends continues to be the most important source of real estate agent, team, and brokerage performance data. We do performance tracking and recognition for top performers in real estate. And that business also had an event. And that event was fabulous. It was called the Gathering of Eagles. It brought together 300 of the most powerful real estate brokerage owners in the country. But we bought it in a year where the event wasn't hosted because of COVID. So we had the bones of like a lot of event knowledge that we hadn't formed internally. I'd say like we were kind of doing things on like a shoestring, like decent events. And this was like executive powerhouse, white glove, like awesome experience. And the first year we hosted at the Broadmoor in Colorado Springs, incredibly nice venues. And that experience that we kind of acquired into the organization changed the face of how we do events. So that kind of elevated our strategy to serving executive audiences. So today we have 5 events, and all of those events are focused on the owners, executives, and decision makers inside of real estate brokerages, home builders, and mortgage lenders, which is different than where we started. So that first strategic move in 2020, acquiring RealTrends, was kind of the real testing point. Are we good at add-on activity? Are we good at integration? And can we grow businesses post-deal at a much faster rate than they were being grown at previously? And we definitely proved that out with RealTrends.
And so RealTrends was both data and event business because it had these rankings, and then exactly. It had the Gathering of Eagles event.
Yep.
And of course, if it's not obvious to the audience, one of the amazing things about a media business is that you are your own distribution. So turning on an event, you have a captive audience that you can then drive ticket sales to, in theory. as with all of these things, it may never go quite as it should in theory. How did that particular piece go? Were you able to grow these acquired businesses pretty readily because you had such incredible reach, such incredible distribution?
Yeah, each of our M&A deals had a little bit of a different strategic complexion. So with RealTrends, that was propelling our strategy forward of bringing mortgage and real estate closer together. And the biggest challenge we had as we later moved the RealTrends Gathering of Eagles to HousingWire The Gathering, which is our event that is for all housing executives and senior level professionals, is convincing the audience segment that had been going to that event for decades that we weren't diluting the quality and we were going to give them a better experience as we expanded the size and expanded the audience to match that HousingWire thesis that I talked about in the very beginning. We're not just for one segment. We want to bring people together across the housing sector. So that was one of the biggest challenges, Will, in growing that business, was helping the audience and attendees see the unique value that our vision would bring. And we have 1,000% achieved that. It just took a few years. And the digital strategy, the having owned and operated distribution, gave people a taste of our approach and how we think about content and how we think about community 365 days a year and 360 days a year before the event. So people aren't exactly walking into an unknown when they bought a ticket to that event. They already see our approach, they see our style, they see our access, the energy, and I think that helps in launching event businesses inside of a media business at a pretty high degree.
Well, so that's kind of a subtle but important point. So, because on the one hand, we talk about distribution. You have a list, and you can market the event to the list, and you don't have to pay rent lists from other people or pay for distribution other ways or pay Google or whatever for PPC, whatever it is. However, event organizers who don't have their own audience do it. That's one benefit. But the thing that you just said is you're also kind of treating the year-round news that you're putting out via HousingWire as an exercise in branding the event, almost kind of working people down the funnel, or maybe that's not because if you don't have an active event being sold, but this idea that because a lot of event organizers just kind of promote the event two months before the event. Versus what you guys are able to do is this year-round reinforcement of we're the people behind the event. This is the kind of content that you're building trust and authority and credibility all year round, not just when you're pushing to sell tickets.
Exactly. And so we don't think of the audience in a funnel. We think of it in a flywheel. And a news article might move somebody to being a newsletter subscriber, to listening to a podcast, to signing up for an event, to testing out a freemium subscription on our Altos SaaS platform for housing market data, to becoming a paying subscriber for Altos or a paying subscriber for HousingWire. And as that flywheel rotates, people move through our business, experiment with the different products that we have, and then hopefully share content and refer HousingWire Altos to clients. So we think of it as a flywheel model that spends 24 hours a day, 365 days a year, which I think is the right way to run this type of business. But the challenge that presents in comparison to the example you shared of someone who just runs an event and markets hard for 2 months before and then sits back for a little bit afterward, is that person, that organizer, gets to think about one thing all month, all year, and that's the event. I wake up every Monday morning with 6 important revenue lines that need attention and an 8-person leadership team who divides and conquers extremely well, but all have our respective focuses in the business that you still can't operate in a silo though. They have their focus, but to run a flywheel the right way, our editor in chief needs to know what's coming up the pipe from product and needs to know what marketing's working on and needs to know if there's any content launches from the sales team that impact editorial. Our sales leader has to understand the audience development process. Our product leader is working with everybody in the company on technology or data initiatives. So we have all these different focus areas that we've learned to to communicate well, integrate well, like have the right meeting and communication structure where everybody can stay up to speed. But we think about 6 meaningful revenue streams every single week, and that's the difference.
Yeah. No, it's certainly a more complex ecosystem that you have than versus just an event organizer.
Yep.
But it is so powerful. Your flywheel. They're so complementary, all of them. I mean, to use the annoying term, they're really synergistic. And if you catch a new reader, a new potential entrant into your ecosystem with one of the 6 product lines, there's a good chance that those one or 2 or 3 or all of the other 5 will at some point also they'll need value from that.
And and so the sum of the parts is definitely more valuable than the pieces, and the integration is how it all works. So like for an example is our lead analyst Logan Motoshami might be on CNBC talking about housing market data. He's referencing HousingWire's coverage of Altos data. So we're introducing Altos to that whole CNBC audience. The next day he's on the HousingWire Daily podcast hosted by our editor-in-chief, Sarah Wheeler. He's referencing a conversation he had on CNBC, still talking about that Altos data and talking about the event stage he's going to be on next month.
Exactly.
On the event stage, we're talking about the pieces flow together and in an organic way.
Organically.
And,
it's not forced. It's very natural.
Yeah.
No, that's so cool. I just love it. Tell the audience, so we're talking about these product lines, but they're also individual business models, each of them. Mm-hmm. Give us a 2-minute primer on both the events business and a data business. So in the events business, I'll just tee you up by saying media people, B2B media people know that events can be great businesses, very lucrative, very high margin. If you have a banger of an event, they can also be, there's just a lot of volatility in the performance of an individual event. I don't mean from year to year. I just mean event A does great and event B is a money loser.
Yep.
But when they do well, they can be the jewels of the crown for media organizations. Tell us more.
Yeah. So today we think about the business in 3 core components: media, events, and subscription and data as a third tier. We never have sought, nor do we seek to have events be the most important leg in the stool. It is one of the legs. And a reason that events has gotten a lot of attention from our executive team and a lot of resources that we've launched more events in the last few years is because of the role it plays in the flywheel and because of the role it plays in our audience and customer relationship. So as a digital media company, and you know this, Will, you get to have one-way conversations with your audience of thousands of listeners, but there's not a lot of great opportunities for those listeners of the podcast to communicate back with you and have a conversation and put a face with the name and shake hands. That's what events has really enabled for us. So we have this 365-day-a-year relationship through people's inboxes and phones. But that's not a great two-way path. Events have helped us put faces with names of these people who have been great sources, readers, clients for years. And that, one, helps with loyalty and retention, but 2, gives us a much better beat on what our audience and key listeners or readers want and expect from us. So when we have those interactions at our events, it helps our editorial team build out better source relationships. It helps our editors better understand strategically what our audience is interested in. It lets our account managers and account executives get face-to-face time with key advertisers and marketers to see what audience segments are most valuable to them or what products they're having the most success with. It lets our executive team build relationships with the other CEOs and operators and understand if the strategic direction we're taking this business in continues to make sense. So you can do all of those things at other people's events, but it's a lot more impactful under your own roof. And that's one of the big learnings we've had in the event side, outside of running profitable, attractive margin events.
Mm-hmm. And do you find that there is the performance of events is difficult to maintain? And as what I mean by that is, I'm thinking of an event that in its first year, everyone talked about how great it was, and then went back for the second year, and the second year wasn't so great for whatever reason.
Yeah.
And so third year now, they're having a hard time with ticket sales. And I've always had the sense of events that it's not that you stop trying to execute, but that there's a certain unpredictable je ne sais quoi in the magic of an event. And it's hard to just playbook it and replicate it reliably.
We've been fortunate where every event that we've hosted in the last few years, we've left with the feeling of, all right, I don't know how we're going to top that, but we'll figure out a way. Like the feedback and the energy has just been so high. And when the feedback and energy is high post-event, it's the right time to capitalize on getting people to sign up for the next year and encourage them to bring a friend or colleague. And that even inside of the little event flywheel, that keeps spinning for us. But one of the things that I've seen as I've observed other events is that je ne sais quoi, as you mentioned, or the energy means that it gets lost when organizations start to treat events as a product suite that's fully delegated outside of like the core leadership team, and executives don't actually attend. They market, but they're not there. We think of these events as incredibly important, like touch points that reflect our DNA and our energy and our people. And that's really reflected. So I think as I think about the elements that are most important for us to maintain, not to lose that je ne sais quoi, is like making sure that our president and myself and our editor in chief, our hands are still on the speaker selection and then the creative side, the music selection, and like the way we treat guests and the hospitality element, that all has to stay high in the model that we're running, which focuses on the executive attendee. And we're fully cognizant that our rates are not cheap. We're not trying to serve the mass market here. We're trying to serve the leaders. And if you want to keep attracting leaders year in, year out, you better provide an experience that matches the client.
Great, Clayton. Now tell us about data businesses and kind of the structure of them and what to like, what not to.
So we got our toes wet with data through the RealTrends acquisition. We really propelled the organization forward in 2022 with the acquisition of Altos Research. And Altos tracks all active market real estate listings across the country. We have over 99% national coverage, which is an incredibly high bar to pass. I'd say from like a data perspective, we compete in some way against MLS data, but MLS data alone doesn't get you to 99% national coverage. So we're an incredibly important data source that appends other data sets or serves as an independent data set for clients who don't need the intellectual property assets of real estate listings, like listing photos. Like we are purely in the numbers. We're not are not fueling the next Zillow, but we're in the analysis and the numbers side of the real estate market. Altos has two revenue lines: data licensing as well as SaaS. So our SaaS product sells to real estate agents, title reps, and loan originators, giving them a real-time pulse of what's happening in their local city, regional, state, national markets. Lets them compare what's happening in Des Moines to what's happening at a national level. We all know that people read national level real estate headlines about inventory and home prices, but those national headlines rarely apply to what's happening in local markets. And Altos is the tool that helps housing professionals understand that. In that acquisition, we acquired a great data process and product, but we also gained a really strong team. And today we have a product engineering and data team that's nearly a dozen people now that just didn't exist prior to that M&A deal. And bringing those people into our company has changed the DNA of the business for the better, that we now have product engineering and data integration capabilities that we can apply across the business into HousingWire, into our subscription product, into our events. Primarily those three things that we just weren't able to do before because we have the talent in-house. And like reflecting back on our pre-engineering team days where you have an aspiration, something you want to build, something you want to fix, and you have to lean on a third-party vendor or contractor to do that, that slows you down a lot. And you lose the intellectual property and intellectual capital that you gain through multiple projects on one data set really quickly when you're just relying on vendors. So the DNA of the company like was in an additive way, went from like newsroom DNA to like news and data DNA that are now connected like at the hip. And that's pretty cool to see.
Well, you're smiling with excitement. I can feel it.
Dude, it's nuts, man. Like I'm at a point now where like I had a vision for HousingWire and a vision for media and data together, but now I have a team who's like executing on the vision, but pulling forward functions and features that I never could have dreamed of. And like it's the integration and the way that we're now able to hire editors who know Python and know how to use AI to integrate data into content. It's like the team has just changed for the better in a dramatic way of technical talent who understands the housing industry, understands the importance of real-time data, and understands what our audience demands. And that's that couldn't be more pumped about the product launches and feature improvements that we have rolling out in the next 6 months. We just had a town hall where our product team gave an overview of the pipeline for the next 6 months. And I think everybody left that with like their jaw on the ground, like this organization is changing.
No, that's really exciting. Well, Clayton, one thing that really comes across is, well, we've already said it, but how unsiloed everything is. Everything is very tightly integrated and it all kind of bleeds together. And it, some being greater than the whole of the parts or whatever it is, whole being greater than some. So this whole ecosystem, this content and data and media ecosystem that you've built just becomes kind of more and more robust. Also, as you think about, I don't know when, but it's completely differentiated. I mean, there's only room for one such business in any industry. And you're it for one of the country's biggest industries. So how do you think about the value you've created here, dollars and cents? I mean, not to say put a valuation on the business, but give us something about how we can think about it.
Yeah, I mean, so when I think about building value, I think about customer retention, reducing churn, and transitioning as much revenue and growing as much revenue in our highest quality areas as possible. Like subscription and data really matters. And so the SaaS revenue growth, data licensing growth, and HousingWire subscription growth, which is our content subscription, gets a lot of energy inside of our organization. But we also have this massive responsibility to serve our advertisers in a really hands-on like VIP way, because we know that our clients on the advertising side have been incredibly important in helping us build this business and build the knowledge and partnerships that are helping us carry it to the future. So there's emphasis across the organization on NPS, churn reduction, the metrics that really matter toward building the highest quality revenue base we can. And then I don't know what else I should be thinking of from valuation. We think of scale, like we do. We still look at M&A. We know like there's some power that comes with size and resources. And every time we've done a deal so far, it's brought in a new capability and in some financial firepower to help us go further faster. So when I'm thinking about building valuation, well, it's about scale and revenue quality are getting a huge percentage of my attention.
And where does revenue stand today?
So we're We'll finish this year between 4 and 5x the where we started at 4 million in 2016. A percentage of that growth has been organic, a percent through M&A.
Sure.
But we've proven we're pretty good at acquiring small businesses and helping them grow faster than they were before. We're
approaching 20 million. Amazing.
Yep. Yeah.
Clayton, I don't think there are that many B2B publishers in single categories that are doing $20 million of revenue. Also, as you've given us a picture of what HousingWire is today, as I just said, it's very differentiated. It's kind of its own animal. You've been figuring out how all the pieces fit over these years. All to say that, like, when you go to a conference for media business owners, does such a thing exist? I don't feel like there are many that you would have many counterparts around the country. This feels like a pretty unique animal, what you've built.
I'll give the one event organizer that matters to me a shout out. Jacob Donnelly, a media operator. I don't know if you followed AMO, but Jacob puts out a fabulous newsletter and media product, and he hosts one event each year in October in New York. And that's an event that I don't miss. So yes, you're right. There's very few others. A lot of other media events have focused on the traditional trade publisher, the print publisher. And like I've attended a few of those in my earlier years at HousingWire and quickly learned it wasn't for me. All of the conversations were very woe is me, the world is ending, print is dead, I don't know how to run this business in a digital world. And like we were fortunate to have like the energy, the digital like native team, the aspiration and resources to achieve something bigger. And so I got myself away from the gloomy side of media pretty fast. I knew that wasn't the game we were playing.
Yeah. Well, but let's now turn our attention to the gloomy side here, Clayton, for the benefit of the audience, who is somebody who might like the idea of being in a media business of some kind. What do you think that there are opportunities for searchers? Maybe the playbook is taking a print publication digital. Maybe not. I don't know. What do you think?
I mean, there's a lot of investors and aggregators who are running that playbook. I think someone that is, looking at business media or print publication in any vertical and thinking about, hey, I'm going to take this digital. There's a lot of considerations. So like 100% great brands can move from print to digital. And like there often is, sometimes there's a reemergence of what's old is new again. There's print publications that were killed that are now coming back now in a very premium format for a more niche audience. And that can be a profitable business as well. What I would caution is that the time to take a traditional print publishing brand to a scaled digital audience doesn't happen overnight. So that needs to align with the timeline of the investment thesis to really achieve what I would assume is a multiple expansion strategy. So you can buy print at very low multiples, very low, very low. And digital trades higher, subscription trades higher. So you can make the conversion, but make sure you're realistic with the timeline and realistic that the team probably needs to change out 100%. Maybe there's an editor, maybe there's an editor. I think that's probably it. That needs to stick around in that conversion. But the sales team that sells print is not the same as the sales team that sells digital. The product manager or ops person that manages the logistics of a print publication is not the same one who manages a website and digital ecosystem and modern email database. The executives, different people. So like that would be something I'd be very cognizant of, that there's probably a complete staffing change to take, what's old and make it new.
Which then is just like, then probably the strategy is build from scratch, not buy. So if you want to be, the HVAC industry's go-to authority, it's probably just start from scratch and do a podcast and go from there, or YouTube channel and go from there.
Potentially, Will. There are some business verticals with very strong legacy media brands, and like brands are powerful. Like we've learned at HousingWire that you can acquire transferable credibility through brand acquisitions. I think RealTrends instantly gave HousingWire a lot more credibility at the real estate brokerage audience. We just bought a publication this summer called The Builders Daily, and the editor, John McManus, joined our team. John is helping bring credibility to HousingWire inside of that home builder segment. And I've seen that play out in a lot of other non-business media verticals as well, where a legacy print brand with a lot of loyalty and history can be transitioned into something else. It just takes money, and it's probably not a strategy that you'd want to use like a big senior debt or SBA loan on, and you probably have to overcapitalize a little bit to cover the trough of the J curve. But it's it's recognition of like the path you're running down. Probably a lot of money to be made in that, but it's not going to be money you can make if you're carrying 3 times senior and heavy covenants and you know you have to spend to grow. Well, and given that, do you see opportunities for this audience in other ways in media? Or is that, so it doesn't have to be B2B trade publications necessarily. Maybe it's something else. Is there an entry point for searchers into media of any kind, or is it probably just not the right format to go after media because media is so in flux still? No, I don't think of media as the right areas as like this like volatile influx area. I think business media has a lot of strong businesses. The challenge is uncovering companies are at the revenue and EBITDA threshold that searchers want to buy at. One of the great and tough things in media is companies are often perceived as being significantly larger than they are because of the brand reach and audience size. There's a lot of media publications that we've approached from an M&A perspective where, I assume this is a 10, 15, $20 million publication. You get under the hood like, oh, this is a fraction of that. Great brand, no monetization. And then you have to ask yourself, is there a reason for that? Like, was it just a bad strategy, or is there a ceiling in that vertical that the company can't grow past a certain size? So understanding the tangible market, like, are you getting into a vertical that can grow to 10, 20, 50 million in revenue? And are there hundreds of millions in advertising dollars and subscriber dollars out there to chase after? Then it gets interesting. But a lot of niche media is by definition niche, and some of those niches aren't as big as people think they are. Well, and I said about that the industry that you're in is one of the country's largest. Yep. So, and I'm hearing you kind of say something similar now. So it does feel like that there are a lot of industry publications, and there are a lot of that are small because their industries are very small. There aren't that many really large industries, and housing is one. I mean, of course, there are a lot of large industries, but I mean, you're in one of the very biggest, and so the industry itself, you'd start with that, and that's a short list. Yeah, the 2 characteristics, Will, that I think are most important when you look at the successful business, media, and information companies are. Is there high regulatory and government involvement? If there's high regulatory involvement, that means change is going to be frequent, and news, information, and data about regulation, governance, government involvement becomes really important. And that means that everybody in the industry has to follow it. So, I mean, think of your examples there: logistics, healthcare, housing, like areas where government involvement plays a big role in the success of the industry. The second is capital intensity. So industries like commercial construction, manufacturing, logistics, again, where there's big CapEx spend. People are buying tractors or concrete or like something that like moves earth and costs millions of dollars. That means the advertising dollars are going to be attractive. When clients are selling a $10 million tractor, they tend to spend a lot on advertising it. So I think capital intensity and government or regulatory involvement become pretty important boxes to check when evaluating verticals and business media. It's a great point, Clayton, and it's one I heard from my guest, Nathan Gregory, of a couple of years ago. Nathan bought Auto Body News, traditional B2B publication. And one of the things that he pointed out was that the
what is being advertised in the pages of Auto Body News are, $100,000, $300,000 lifts for, repair garages sort of thing. So, one sale every 2 years from an ad spend pencils for the advertisers. And that always stayed with me. And I've heard you just restate that. So those two, and then that or the regulation piece, great insights there. Clayton, anything that we didn't get to that you wanted to share with the audience?
Man, I think we covered a lot today, Will. I appreciate you digging into parts of my story that I haven't talked about publicly. We definitely went into areas that made me think, and hopefully we added some value to the audience today.
I can tell that you're comfortable in media. You're a very natural guest. You've been host of your own podcast?
Yes. Yeah. I launched a podcast called Powerhouse a few years back for HousingWire. I've hosted a couple hundred episodes of that. And last year, the president of our business, Diego Sanchez, took over hosting. I found it an incredibly valuable tool for building relationships in the industry. And now he has the opportunity to do that. But I am, actively thinking about my next show. We're in a new office, Will. We just built out a space in downtown Dallas and have a podcast studio that is like right outside my door. So now I'm just like tempted looking at the space every day. Like, now what's my next show? What am I going to host?
And why did you hand it over to Diego, the other one?
It was two factors. It was one, time management. I felt like I was stretched too far. I was trying to host a weekly show, and in the beginning, I was really good at scheduling months in advance and planning content months in advance. And then it got to the point where Monday morning would come around. I'm like, all right, who am I going to host tomorrow? And that was just being overcommitted on time. And I needed a little more bandwidth in my life. And the second being that what I just mentioned about how hosting a podcast or another media format can help with relationship development and meeting cool people that you learn from, that you also may have an opportunity to do business with.
Yes.
Podcast hosting provides that. And I kind of saw that as a gift I could give Diego and our business by giving him some of the advantages that I had kind of found through hosting the show.
Yeah. Yeah, absolutely. That's great. Well, content is wonderful and fun, but there's a lot that goes on behind the scenes that, it's easy to underestimate the lift that is getting content out the door. Cause on the one hand, it is just flip on the mics, hit record, upload the MP3 to Transistor, and you got a podcast. But to do it well and consistently and professionally, it adds a lot of hours to the week all of a sudden. So it's a very interesting product because it's very low barriers to entry. Truly, it's very easy to get either audio content or written content out into the world. Super easy. Technology makes it easier all the time. But for that reason, it's a lot more crowded out there. So to rise above, this has become much more competitive. But again, to kind of do it well and produce a good content product takes a lot more than just that.
I was going to say our most popular show at HousingWire is called HousingWire Daily, that Sarah Wheeler hosts every single day. And the lift of doing 5 episodes a week is significant on her guests and our editors and producers. It's pretty wild to see the amount of effort that goes into that show. But it's a top 10 business news podcast on Apple. We'll get close to 2 million listeners this year from what I'm projecting right now. And so when you put the right effort in and produce the right product, the audience pays attention. And while the bar might be low to launch a podcast, the bar is pretty high to have a quality show.
Yeah. Yeah. Amen. Well, let's leave on that note. Clayton Collins. Yeah. Cheers to you. Cheers to us.
Cheers to Acquiring Minds.
Thanks for coming on, sir. Thanks for your transparency. I just personally, selfishly, I was really looking forward to this one for obvious reasons. So I thank you for saying yes and for joining us.
Thank you, Will. It was fun.
Hope you enjoyed that interview. Don't forget to subscribe to the Acquiring Minds newsletter. We send an email for every episode with an introduction to the interview, a link to the video version on YouTube, and soon key takeaways, numbers, and more essentials from the interview for those of you who don't have time to listen or watch it. Subscribe at acquiringminds.co. You'll also find all our webinars there on the website, both those we have coming up and recordings of past webinars. At this point, there are over 30 webinar recordings, a wealth of information on all the technical nitty-gritty of buying a business. acquiringminds.co.